You know that sinking feeling? When you open your investing app, glance at your portfolio, and your heart drops faster than the market itself? Red numbers everywhere. Your stomach knots up, your brain starts spinning, and you think, should I sell? Should I do something, or just close this app and pretend I didn't see that? Yeah, we've all been there. So let's talk, really talk, about what to do when the stock market dips. Not some boring financial lecture, not another keep calm and invest on cliche, but a real, human, step-by-step plan to stay sane, stay smart, and even come out stronger when everyone else is panicking. Because here's the truth. Dips aren't disasters. They're moments of truth. Step 1. Don't panic. Feel it, but don't feed it. Let's start here. Because this is the hardest and most human part. When the market falls, your first reaction isn't logic. It's emotion. Your chest tightens, your thoughts race, and suddenly every bad headline feels like it's shouting your name. Market crashes. Investors lose billions. Your brain goes into survival mode, and that's normal. We're wired that way. Imagine you're standing on a beach and you see a wave coming. Big, powerful, rushing straight at you. Your instinct says, run. But the market isn't a wave you can outrun. It's an ocean. It moves with tides, not tantrums. So first, breathe. Literally, take a deep breath. Close the app. Step away from the noise. Don't make any decisions in that emotional moment. Not to sell, not to fix anything. Because every big financial mistake begins with a small panic reaction. Step 2. Remember why you started investing. When you first started investing, you probably had a reason. Maybe it was freedom. Maybe it was security. Maybe it was to stop living paycheck to paycheck or to one day buy a house without a mortgage that owns you. That reason, your why, doesn't disappear because the market went down this week. Let me tell you something about every successful investor you've ever heard of. Warren Buffett, Peter Lynch, or that quiet person at your office who somehow retired early. None of them got there by reacting to dips. They got there by remembering why they were investing in the first place. Dips test that why. They whisper, hey, maybe this isn't worth it. But if your reason was strong enough to start, it's strong enough to stay. Step 3. Zoom out. Look at the bigger picture. Open any long-term stock chart. Pick your favorite index. The S&P 500, NASDAQ, Dow Jones, whatever. Scroll out, not in. What do you see? You'll see dips. Many of them. Crashes that, in their moment, felt like the end of the world. The dot-com burst. The 2008 financial crisis, the pandemic plunge of 2020. And yet, every single one of those charts climbs again. Sometimes slowly, sometimes explosively, but always upward over time. Step 4. Check your foundation. Think of your investments like a house. The foundation isn't the stock price, it's your plan. Ask yourself, did I invest money I actually need next month? Do I have an emergency fund? Am I diversified, or did I throw everything into one stock because a YouTuber said it was the next big thing? If your foundation is weak, a market dip can shake the whole house. But if your foundation is strong, solid savings, clear goals, diversified holdings, then even a storm won't knock you down. Here's a little test. If the market dropped another 10% tomorrow, could you handle it without losing sleep? If not, that's not a sign to sell. It's a sign to rebalance. Strong investors don't predict the market. They prepare for it. Step 5. Revisit, don't react. There's a huge difference between reacting and revisiting. Reacting is emotional, it's impulsive. It's what people do when they let fear drive. Revisiting is calm. It's thoughtful. It's like checking your map before a trip. When the market dips, revisit your plan. Are your goals still the same? Are you still on track for your timeline? 5 years, 10 years, retirement? Maybe your risk tolerance has changed, and that's okay. The market gives you a chance to reevaluate, not to retreat. Remember, dips are feedback, not failure. The market is basically saying, hey, just checking. Are you still comfortable? If yes, hold steady. If not, make slow, smart adjustments, not panic moves. Step 6. Look for opportunities, not just problems. Here's the part most people miss. Dips can actually be gifts. When prices fall, value investors, the calm, patient ones, quietly buy quality companies on sale. It's like your favorite brand running a discount. But instead of shoes or phones, it's shares of strong, profitable businesses. Now, this isn't about timing the bottom. Nobody gets that perfectly. It's about time in the market. not timing the market. If you can keep a long-term mindset, every dip is a potential doorway to future gains. Step 7. Block out the noise. You know what makes dips feel worse than they actually are? The constant noise. Turn on any news channel during a market drop and it's pure chaos. Historic crash? Investors flee. Recession fears. They're not wrong, but they're also not helpful. Their job is to get attention, not to help you invest wisely. Peace of mind is part of your portfolio too. Step 8. Talk about it. Yes, really. Money is emotional, and pretending it's not only makes it worse. If a market dip has you stressed, talk to someone. A friend, a partner, a mentor, or even a financial advisor who gets it. Saying it out loud helps you process it. Sometimes just hearing someone else say, "Yeah, this is normal," can calm you more than any chart or data point ever could. Step 9. Stay the course, but keep learning. Market dips are like pop quizzes. They test what you know, and they show where you need to learn more. If a drop shakes your confidence, use that energy to educate yourself, not to escape. Read about market cycles. Learn what caused past crashes and how investors recovered. Understand how compound interest works and why time is your greatest ally. Because once you truly get it, once you see that dips are normal, even necessary, the fear loses its grip. Investing is a lifelong class, and every dip is just another lesson. Step 10. Keep your eyes on the long game. You don't plant a tree and dig it up every week to check if it's growing. You water it. You wait. You trust the process. Investing works the same way. The stock market rewards patience more than precision. If you zoom out over decades, not days, the picture becomes beautifully simple. The market dips, it rises, it dips again, and it keeps trending upward, just like human progress itself. So when it dips, smile a little. You're seeing the system work. Volatility is not a glitch. It's part of the design. Fast forward 2 years later, her portfolio not only recovered but grew far beyond what she imagined. Was she lucky? Maybe. But more than that, she was calm. Her success wasn't timing, it was trust. So next time the market dips, and it will again, remember this. It's not the end. It's just another chapter in a much bigger story. Take a breath. Trust your plan. Stay steady when others shake. Because while panic sells fast, patience compounds quietly. And one day, that patience becomes your freedom. You've got this. If this helped you breathe a little easier, stick around. Hit subscribe, follow along, and let's keep learning how to grow wealth the calm, confident way. Together.